Welcome to Wealth Protector TV. Really excited to have you here. And I have a great guest. It's the founder of Barth Calderon, an asset protection, estate planning, business planning firm, Harry Barth. And he's going to be talking about the common mistakes people and professionals make when they're setting up limited liability companies. It's really important because when you set these up, you need them to work. And if nothing ever happens, no liability comes your way, who cares if you didn't set them up right or you're not maintaining them properly? It's when something happens and they get tested. Creditors coming after you. There's an attorney on the other side, which is why you set these legal entities up in the first place. When they come after you, they will attack your entities. And if you didn't do it right, not maintain them right, they'll fall apart and it becomes a personal liability to you. So let's jump in and listen to Harry pull back the curtain and tell you exactly the mistakes to avoid and how to do this right. Great to have you here. Hi everybody, this is Paul Hitchcock at Barth Calderon. Thank you for joining Wealth Protector TV. We do this on an ongoing basis to provide you value, keep you updated. Very excited to have our founder and senior managing partner, Harry Barth, with us. Harry, welcome.
Well, it's good to be here, and it's always great to be on Wealth Protector TV. I think we use this quite well in helping all of our constituencies understand various different concerns that we have in the legal arena. Today, I want to talk a little bit about the 7 top, we'll call it mistakes or misunderstandings that people make when they're dealing with limited liability companies.
Okay.
As most people know, Paul, limited liability companies have been the type of organization that seems to be most favorable. It's like the Swiss Army knife of organizations, and seem to be the predominant organization that's being used for people starting businesses, remaining in businesses, holding property, holding assets, holding stocks, bonds, and cash. Yes, limited liability companies are more flexible, and just their very natures, they're limited liability. They have better asset protection. When we look down from the liability to the owner, they have less requirements for the maintenance of the entity. So they're used quite frequently. And a lot of people think that, you go on to LegalZoom or check the box and you have an LLC and away you go. Well, it's not quite that simple. So today I want to talk about some of the things that I see when we are helping people form limited liability companies and with limited liability companies themselves.
Yeah, because so many people seem to be banging these out today. They don't realize the problems that arise.
Yeah, and we'll pick up about 6 or 7 of those right now and talk about them. Not into in-depth analysis, but for the issues, the headline issues that everybody should be concerned about. So the first one, not necessarily in order of priority, has to deal with management of a limited liability company. It's not managed the same as a corporation. We have two different predominant ways in which limited liability companies are managed. Limited liability companies could be managed by the members, or limited liability companies could be managed by an independent manager. Sometimes the independent manager are the members, and sometimes the members are managers, and vice versa. But irrespective, we should spend some time thinking about what is the best way in which to manage the limited liability company. We have found that more likely than not, the most flexible way for today and for the future is to have a limited liability company managed by the manager or managers rather than a member managed limited liability company. And so if we have manager managed, which is more flexible, we can have different entities as managers. It just makes a lot more sense, more flexibility and transference of limited liability company shares or interests as we move forward.
So
we have to also then think about, if we have managers or how we manage, what happens if we have a disputed management? Or we have 4 managers, two vote another way, and we're deadlocked. How do we break a deadlock? What happens if a manager is not behaving
Okay, I'll
Correct,
let her
Billy.
know.
So one of the things
maybe
we
someone
see
call
is
back.
that in a
Thanks.
standard out-of-the-box LLC, it's managed by the members, majority rules, and that does not necessarily give us the most
I'm in
efficient
the middle of
limited
something. What's
liability.
going on?
Yeah.
So the second thing that we see with limited liability companies is not enough depth and precision being built into the operating agreement. Now, the operating agreement is the most important document in a limited liability company. They're organized with the articles of organization, but the rules, the playbook by which everybody governs themselves is based upon the operating agreement. Now, in many states, operating agreements are not even required, which all means is that the operating agreement is written for them by the state.
Well, that's what, does it default to the state?
It defaults to the state, right?
It does.
So, for example, if you form a limited liability company in California, you don't have an operating agreement. There's an operating agreement. It's just written by the state, and it may not have. And in every area where the operating agreement is not sufficient, the state steps in and fills in the blanks. And it's not necessarily what we want. So, if we're going to take the time, everybody wants to take the law into their own hands.
Right.
And here we have an opportunity to pretty much say how the law is going to apply for our company, and we can write the law. So that is absolutely amazing, but it does require the time to put together a comprehensive operating agreement. So mistake number 2 is we don't have comprehensive operating agreements. Let's spend a little time going through all the areas that need to be covered by an operating agreement, discuss them, see how the company and its members are going to work in those areas. And it's so helpful. Buy sell provisions, restrictions on transfer, restrictions on loaning, what happens if there's a dispute, how you deal with management, and a lot of issues come to play in the operating agreement. And so the operating agreement needs to have some depth and not just an out-of-the-box operating agreement
Harry,
whatsoever.
When somebody says build asset protection provisions into the operating agreement, like we do, is that what you're talking about?
Yes. There's a couple things. It depends again on the purpose of the limited liability company. Sometimes the purpose of the limited liability company is just to run a traditional business. All right. And we're not as concerned about putting a wall around the assets. We'll call it a domestic asset protection limited liability company. And different operating agreements are different based upon what we want to do. So, for example, if we're concerned about asset protection, our operating agreement will be very, very restrictive. If we're talking about doing business, it's a new business, we want to be the most flexible to get the best financing, bring in as many people, that operating agreement will be more liberal. So again, depending on the purpose of what we're trying to accomplish, the operating agreement, what I'm trying to say in our mistakes is one size doesn't fit all. It should be well discussed, well negotiated amongst the owners of the limited liability company. The next mistake we see is it has to do with taxation. Limited liability company is extremely flexible from a tax perspective. A limited liability company unto itself does not have a tax status. Limited liability companies, by default, if there's more than one person, are taxed under partnership tax rules. If there are a married couple in California or a single member limited liability company, it can be disregarded for tax purposes. So it's there for legal purposes, but doesn't exist for tax purposes. A limited liability company can elect to be taxed as an S corporation, or a limited liability can elect to be taxed as a C corporation. So the choice of how the company is taxed. So for example, in California, a limited liability company is subject to a minimum tax of $800 plus a gross sales tax based upon the gross sales of the entity. So many people feel that if you have a limited liability company, you're subject to both of those taxes. But if the limited liability company has made an election to be taxed as an S corporation in California, it'd be subject to a completely different tax regime and not subject to the gross sales tax. So again, the inaccurate tax choice is a mistake that we see. Should it be taxed as a partnership? Should it be taxed as an S corporation? Should it be taxed as a C corporation? Or in some cases, should it be treated as a disregarded entity? Again, right out of the box, we don't necessarily know And that's where really good, and that's also baked into the operating agreement as we put together a comprehensive limited liability company. The other thing too, the other mistake we see is that people transfer properties. We'll talk about real estate here for a moment into a limited liability company. Limited liability company is a great entity to hold real property, and most real properties held, commercial real properties held in limited liability companies. It's protective so the liability from the property doesn't reach to our personal assets, and it's protective if structured properly that the property itself may not be easily obtainable by a creditor should there be a liability to the owner of the limited liability company. So people put their properties inside limited liability companies. And what mistake do we see? They don't change their insurance. The insurance no longer names, the insurance was in their name or the insurance was in another name. And now the property has been transferred to a limited liability company, and the insurance company that insures the property or the assets was never informed that it's now owned by a limited liability company and could have an impact on coverage. The other thing we see in the same vein is that title. In other words, we have title, we bought title insurance, we bought the property. Now we transferred the property to a new owner. The limited liability company just usually requires a simple update to the title insurance, and people fail to do that. So we see that as another error. So we want to make sure that the insurance and title are appropriate for the assets that have been placed into a limited liability company. The other thing we see, which is really, really interesting, is an error, is people say, yes, it's a great idea. We definitely formed a limited liability company to hold our apartment building or to own our Airbnb, whatever it may be, and that's great. And they called, Paul's Real Estate Holding LLC in an appropriate and proper jurisdiction. And that's always a question too. There's never a wrong jurisdiction, but there's some jurisdictions that are better than others. And then upon analysis, when we actually look inside at the limited liability company that was formed, on many occasions, we see this mistake. The limited liability company was formed, was filed with the Secretary of State. They're collecting rents, the leases are written with the limited liability company, but the deed to the property was never transferred into the LLC. Okay. So the LLC is acting as a service company, but it does not own the property. And so if there's a liability at that property, it's an individual liability and not an LLC liability. It is a grievous mistake. And we've seen it all too frequently where the assets that are anticipated to be in the limited liability company, I have the assets, I have a perfectly formed limited liability company, but I never made the transition. It was never completed along the way. So I see that as another mistake constantly. Another one that we see on that same vein is the failure to move the interest that's held by the owner in the limited liability company into their living revocable trust. All right. So we see it all the time where they create an LLC, it's Paul's LLC. We effectively deeded the property in. We have a great operating agreement. Everything about the LLC looks good. But then we should, as a next step, we should have had that LLC been assigned or formed by your living revocable trust. If we don't have that and there's a death or perhaps even an incapacity, there is a great possibility, or more likely than not, that the limited liability company, which may hold some of the largest assets that a client has, is now moving through probate or surrogate court in their particular state.
Heinous. But Harry, when you say assign the interest to the living revocable trust, is that just updating the trust? Is that a?
Well, it's not even updating the trust. It's just a matter of simply saying that Paul, I assign my interest, Paul Hitchcock's interest in Paul's limited liability company to Paul's living revocable trust.
But is that
it's a simple assignment that's prepared by the law firm that assigns it into the living revocable trust. Okay. And now all the assets that are in the LLC are in the trust because the LLC is within the trust. So we see that a lot. In other words, we have an LLC or several LLCs with a bundle of assets, and the ownership interest in the LLC is still in the individual name, not in whatever estate planning tools that were put together on behalf of that particular family. So we see that as an issue. The other issues or mistakes that we see, another one that's quite common, is when we have multiple properties. We deal with this all the time. Someone has 2 or 3 properties, and they have taken the time to build an appropriate LLC with a strong operating agreement, made the appropriate and proper tax elections. They have moved the deed in. They changed the insurance. They have the trust that was done to get it all done. It's a very, very good-looking LLC. It's assigned to the Living Revocable Trust, but it's a mistake in this respect. We have 3 properties in one LLC, and if each of those properties, just for example, has $1 million of equity, right, the net worth of that landlord is $3 million. So if I have a liability at property A, B, or C, the full $3 million is subject to that claim. Now, to me, as an asset protection attorney and just as a business person, does that make sense? Or would it be better if I would have had 3 individual LLCs or 3 subsidiary LLCs, one for each property? Therefore, a liability at property A would only be resulting in property A being impacted and not property B and property C. It's a big difference if you have a $3 million loss versus maximum $1 million loss. And not only that, think about it this way. Not only when we put the 3 together did we increase the net worth of the landlord to the total equity of all the properties in the LLC, think about it this, we've also increased the numbers of targets against that, in that every worker, every guest, every person that's involved, we have 3 times the probability of a liability against a larger pile of equity. So I think it's a mistake not to have appropriate, proper pods, silos, or a series of LLCs to break down that liability into smaller chunks. I think that that's a mistake. You're going to have a question.
What do you do if somebody has like 15 or 20 properties and they say, okay, there's a fee for every single one, and are there different ways to skin a cat when you?
Yeah. Yes. There's always different ways. That the way we structure an LLC or LLCs are limited practically by our imagination. All right, so we can do a lot of things, but when you speak to someone in my position or sees the things that I see every day of the week, and you say if someone has 15 LLCs, my immediate response should be, if those 15 LLCs have value, that as far as I'm concerned, those 15 properties, there should be 15 LLCs. I'm okay with that. Yes, each one has a fee. If each fee was $800 or $1,000 deductible, $500 after tax, that's a very small price to pay to protect all the properties from each other. Right. And one of the things that's important to understand is we have to, if we're going to be in the business, if I have 10 rental properties, I'd like to have each one of those 10 rental properties in separate LLCs. Now, that being said, there may be some properties where the sum total of the equity is not very much. All right. Or where I'm willing to say, hey, look, I'm willing to take up to a $500,000 loss, and I could bundle 3 properties up to $500,000 worth of equity. So it's not just a simple 1 for 1. 1 for 1 is good, but you could have 2 in one, 1 in another. They could be separated geographically, jurisdictionally. But the most important thing is to examine what is the best structure for my asset protection for the properties that I've set up, or the assets that I have set up that are held in a limited liability company. Give you an example. If I had one company, one LLC, and that company had trucks and intellectual property and assets and money and inventory and everything else all in one, and that company represented 95% of my net worth, as it does with many business owners. Their company is their biggest net worth. If I have a liability to the company, it might as well be the same as everything that I have myself, because all 95% is on the line. So we should look at, again, using our imagination and legal creativity, how do we best separate that through the proper use of LLCs at different levels and in different ways.
Great.
And the last a very important point that I'd like to make, a common mistake, is that we as lawyers can help build those structures. But it's very important that clients don't make the mistake of not the care and feeding of the LLC to make sure that's done properly. Each LLC should have its own bank account. Each LLC should make sure that it has all the forms necessary to be in good standing with the state to be done. An LLC does not necessarily have to hold meetings or have shareholder meetings or board of director meetings, so it's a little easier to operate. But we want to make sure that all business formalities are done properly. We want to make sure that the LLCs are not paying personal expenses, in which case a distribution is made to the owner and then personal expenses are paid. So once we build a structure, then the utilization of that structure should be done properly, because that's a mistake if we don't do that, because that opens up the door for a challenge by a creditor that the LLC is not really an independent entity, but is nothing more than a sham entity or an alter ego of the former. And so we want to make sure that that's done properly as well. And if we take all the points that I just brought out today in structuring LLCs, I think that it's a magical entity that could be used in so many different ways and provides significant domestic asset protection for our clients.
Love it, Harry. Always incredible information. I want to thank everybody for listening. Harry, thank you for being here. Stay tuned to our show because we continue to provide value on an ongoing basis, and we'll see you here next time.
You got it. Thank you, Paul. Look forward to it.
All right.
Bye.
Paul Hitchcock here. Thank you for watching this recent episode of Wealth Protector TV, and wherever you're watching this, because we stream it everywhere, Facebook, YouTube, LinkedIn, Twitter, make sure you subscribe and follow our channel because we put out continuous white hot content on topics that impact you. I also want to get you connected to our complimentary assessment. If you've got questions on your own asset protection or estate planning or maintaining your legal entities, as we talked about in this recent episode, then click on the link. You can find it up here, down below, to get connected with our team for a one-to-one session where we give you our input, observations, recommendations, complimentary to help you get organized, updated, and protected. So click on the link wherever you're watching this and look forward to talking with you real soon.